Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today we are doing a deep dive into the really remarkable momentum we're seeing build in Asian equity markets. We're going to be focusing specifically on South Korea's main index, the KOSPI, and how its recent surge is, well, deeply connected to a rapidly shifting geopolitical landscape, a landscape that involves China, Japan, and of course Korea.
And what's really fascinating here, looking at the recent analysis, is that the market drivers in Asia right now, they aren't purely about domestic economics, not at all. They're heavily driven by the strategic actions of global powers. The sources we've looked at show China's using a very calculated carrot and stick approach.
A geopolitical approach?
Exactly. A geopolitical approach to actively reprice investment risk and reward across the entire region. That's almost like a trading strategy, but executed through foreign policy.
That sets a very clear mission for us then. We need to unpack two major themes. First, why exactly is the KOSPI hitting these record highs? What's the engine behind it? And second, how China is intentionally creating this huge economic and diplomatic contrast between its engagement with Japan versus South Korea and, what that all means for your portfolio.
Okay, so let's start with South Korea. The KOSPI recently broke 4,500. That happened for the first time on January 6th, and now you have analysts openly talking about targets as high as 5,000. For anyone outside of Seoul, what does a surge like that really signify? Is it just a rebound, or is it something more fundamental?
It's being defined in the analysis as a structural level up. And that's a key distinction. It's different from just a cyclical rally. This movement is fundamentally about raising the appropriate valuation range for Korean stocks. It's about finally addressing what investors have for a long time called the Korea discount.
The Korea discount. That's a term that gets thrown around a lot, but it can be a bit of an opaque concept for newer investors. Yeah, let's break it down. Think of it practically. You have a company, let's say a major electronics manufacturer. It's world-class. Its technology is top tier. Its products are flying off the shelves. But historically, the market applies a discount to its stock price compared to its peers in, say, the US or Europe.
Why, though?
Because of these constant nagging concerns. Regional security risks, tense relations with neighbors, or even weak corporate governance inside Korea itself. So you have great earnings potential, but this sort of damaged reputation when it comes to stability.
So the level up means the market is finally starting to believe that reputation is getting fixed.
That's it, exactly. Investors are starting to trust that the reputation risk is diminishing, and so they're willing to pay higher multiples for earnings they already knew were there.
And the data around expectations, it certainly shows that confidence. Morgan Stanley was cited raising its targets, and some of the domestic strategists are throwing out these really wide 2026 forecast bands. I'm seeing 3,700 on the low end, all the way up to 5,500. When you see that kind of variance, what does that tell you about the market's conviction?
That wide variance tells you two things. One, investors agree the ceiling has been raised. That's the consensus. But they are sharply divided on how much external risk is left. That 5,500 target, that's pricing in, maximum policy stability, perfect earnings realization, blue sky.
And the 3,700?
The 3,700 suggests those analysts are still pricing in significant geopolitical risk. Maybe a sudden flare-up with North Korea or a sharp reversal of the global AI cycle.
Yeah.
The valuation is now highly sensitive to these external variables.
Okay, so let's dig into the main variable driving those high expectations right now, earnings visibility. The analysis we've seen details the core driver as the semiconductor and AI complex. And the numbers are, well, they're kind of spectacular. Reuters is reporting expectations for Samsung Electronics to see something like a 160% increase in Q4 operating profit year over year.
It's a startling figure.
Yeah.
And the logic underneath it is really critical to understand why this movement might have some durability. The AI boom, we're talking large language models, massive computing needs. It requires this overwhelming flood of specialized AI chips. This new demand is just soaking up all the available manufacturing supply.
Right.
And that, in turn, is creating an unexpected tightness in the market for traditional memory products, specifically DDR5.
So wait, the price isn't just going up because more AI chips are being sold. It's the scarcity created by the AI chips that's lifting the price for all memory.
It's a classic squeeze play. The analysis says AI infrastructure demand is, and this is a quote, overwhelming supply.
Mm-hmm.
And that just pushes traditional memory prices higher across the board. So analysts are signaling that these strong earnings, this high visibility, it's sustainable for the medium term. It's the primary pillar.
And it's interesting to see how the AI association is starting to spread beyond just the chip makers. If you look at the non-chip sectors, some reports detailed a unexpected 15% surge in Hyundai's stock. This is right after their chairman met with Jensen Huang of NVIDIA at CES.
Right, and Hyundai is making its own waves with robotics. They're talking about rolling out the humanoid Atlas in factories by 2028.
But the market reaction was immediate. It seemed to treat that simple NVIDIA link as the direct trigger.
And I think we have to pause on that for a second. Is that a real, durable change, or is that just speculative buzz after a photo op? The market is actively trying to find new proxies for AI growth. If you feel like you can't buy NVIDIA because it's too expensive, you go looking for the next best thing.
The physical AI exposure.
That's the term, yeah. Robotics, autonomous systems. The Hyundai surge reflects the market's search for that physical AI exposure. It means Korea is being seen as a key hardware supplier now, not just a chip maker. But that 15% jump, it just shows you how sensitive investors are to any whiff of an AI partnership.
And that momentum, that sensitivity, brings us right back to the geopolitical tightrope. If the profits look this good, what's the external risk? Well, the current environment suggests the KOSPI success is incredibly vulnerable to what China decides to do. The analysis indicates China is actively deploying that carrot and stick strategy we mentioned, a stick for Japan and a carrot for South Korea.
That's the crux of the whole geopolitical design. So let's start with the friction, the stick, the one being applied to Japan. The sources seem to track the recent tension back to Japan's prime minister, signaling potential involvement in a Taiwan contingency.
Which China sees as a direct challenge to the One China principle.
A direct challenge. And China's retaliation was swift and very economically targeted.
Right. They moved to prohibit the export of dual-use goods to Japan intended for military use.
Which is a very broad category. It often includes specialized materials like rare earths, which are just crucial for drones and advanced microchips.
But it was more than just export controls, wasn't it?
Oh, much more. And this is what's highly strategic. They didn't stop there. AP reports that China also initiated an anti-dumping investigation into Japanese dichlorosilane.
Chlorosilane, okay, what is that?
For the listener, this isn't some obscure product. It's a direct precursor chemical used in the etching process for making semiconductors.
So they're going right for the heart of Japan's high-tech manufacturing sector.
Right at the heart. By targeting this chemical, China isn't just restricting defense tech, they are threatening to introduce massive costs and instability into Japan's entire tech supply chain. It's a multi-layered pressure package. You've got trade remedies, export controls, and diplomatic strain all at once.
And the threat is credible, because despite years of trying to diversify, Reuters confirms Japan is still highly exposed. Something like 60% of its rare earth materials still come from China.
Absolutely. So now contrast that active pressure with the recent warming towards South Korea. This is the carrot. After years of high tensions, ever since that 2016 TIA dispute, South Korea's president visited China specifically aiming to elevate relations. And crucially, Korea publicly reaffirmed its respect for the One China principle during that visit.
And the reward for that was immediate.
Immediate and tangible. AP reported that economic cooperation agreements, new export contracts, we're talking tens of millions of dollars, were all discussed. It created what analysts are calling relationship restoration momentum.
So for Seoul, this is an immediate economic benefit, a needed reduction in political tension. It's the exact opposite of what Japan is feeling.
It is, though we should note the sources add a subtle caveat here. The symbolic Hallyu restrictions, that's the Korean wave of culture, those restrictions on cultural exports remain uncertain.
So China is keeping some sensitive non-economic issues on the table.
As residual leverage, exactly. Even while offering economic relief, they're holding some cards back.
So strategically, what's the end game for China here? What do they achieve by so clearly differentiating between these two key U.S. allies?
They are strategically trying to weaken the U.S., Japan, Korea trilateral security framework. That's the framework the U.S. has been working so hard to solidify. But for investors, the design is crystal clear. China is intentionally applying risk to Japan. That's supply chain uncertainty, sudden policy shifts, and at the same time offering reward to Korea, that's political tension relief, resumed economic dialogue.
So this dynamic is actively and deliberately shifting investment premiums across the whole region.
Absolutely. Money flows where the political weather is currently better.
Okay, let's pivot now to the crucial takeaway for the listener. We've established the KOSPI rally is real, it's driven by AI, but it's operating in this incredibly complex geopolitical environment. So should you just chase this rally? What are the factors that are going to make or break the KOSPI's attempt to stay at this new, higher level?
Well, the analysis suggests you have to deconstruct this rally. You have to break it down into three sustainable pillars, or you risk just riding a cyclical peak. The first pillar is memory cycle durability.
Okay.
You need to look very closely at whether these high memory prices can truly last. If you start seeing key indicators of a slowdown, things like a slowing rate of price increases, large clients adjusting their inventory, or maybe capex overheating and causing oversupply, that level up could very quickly become a level down.
And the second pillar is about perception, how Korea is fundamentally viewed by investors.
Correct. Korea has to prove that it is being traded as direct AI exposure, not just as emerging market beta. Historically, when global growth picked up, Korea was just one of many EM bets you could make.
A rising tide lifts all boats.
A rising tide lifts all boats. But now, investors are watching for a qualitative upgrade. Is Korea just riding high DRAM prices, or is it genuinely expanding its ecosystem into higher margin AI critical fields? We're talking high bandwidth memory, advanced packaging, the specialized equipment for AI infrastructure. That diversification is the sign of a real, durable, structural change.
And the third pillar is internal, the gap within the KOSPI itself.
Yes, we're seeing a growing disparity internally. The premium is increasingly going to industries linked to physical AI. That's robotics, autonomous driving, manufacturing automation. It explains all the excitement around Hyundai.
Right.
So the KOSPI will see this widening gap between those cutting-edge sectors and the more traditional cyclical industries that don't have a clear AI story to tell.
So even if the index goes up, not every stock is coming along for the ride.
Not at all.
And on the geopolitical side, the sources confirm the biggest market shift isn't a one-time tariff. It's something they're calling regulatory contagion, especially for Japan.
Regulatory contagion is such a relevant risk for companies today. For Japanese firms, the real danger isn't just a small price hike on rare earths. It's the constant policy ambiguity, the uncertainty. China can use these vague frameworks, like the military contribution rule, to reclassify almost any dual-use supply chain component.
Forcing companies to completely restructure.
Completely. Restructure international contracts, find new procurement channels, all at massive cost. When they investigate something as essential as dechlorosilane, they send a shockwave through the entire regional supply chain.
And it forces companies to move manufacturing, find other, more expensive suppliers.
And that unpredictability, that is the contagion.
And even though Korea has the carrot right now, that structural dilemma, the tightrope walk, it hasn't gone away for investors.
Not at all. Korea has to navigate an incredibly complex path. It has to maintain its essential security and technology alliance with the U.S., while at the same time improving critical economic ties with China. So as an investor, you have to look past the friendly headlines. You have to rigorously track two things. First, are U.S. tech and trade regulations, many aimed at China, going to compromise Korean firms' ability to operate? And second, is China actually delivering on the carrots beyond just talks? Or will restrictions like that Halley ban remain as persistent leverage?
That tightrope walk adds a permanent layer of structural complexity.
A permanent layer.
This has been an absolutely essential deep dive. I think our core conclusion is that the rally in South Korea, it's built on solid ground. You've got AI and confirmed earnings visibility, but that momentum is inextricably linked to China's strategic use of geopolitics to shift investment risk and reward across the entire region. This dual dynamic of tech growth and engineered political risk, it feels like the most critical factor for any investor looking at Asia right now.
And here's the final provocative thought for you to consider. The conversation is no longer about if geopolitical risk exists in Asia. We know it does. It's about how quickly and effectively China has just demonstrated its ability to instantly translate an external policy conflict like a Taiwan issue into tangible trade and industrial policy moves, like launching an anti-dumping investigation. This strategic weaponization of trade, it fundamentally changes how you must evaluate the risk premium across all Asian nations.
Don't forget to subscribe and hit that like button.